Hello everyone, Elliot Gu here with the Free Market Speculator and the Energy Bulletin, and welcome to my Sunday Deep Dive. In this weekly video, we look at a key chart, trend, or indicator that caught my eye over the past week, and I explain what it means, or at least what I think it means for financial markets. Today I want to dive into three different markets. First, currencies, and in particular, the US dollar traded against other key global currencies, like the British pound, the euro, and the Canadian dollar, and also the Japanese yen. I also want to touch on natural gas here, the natural gas market here in the US. And finally, the long bond. I'm talking about 30-year US Treasuries. Specifically, we're going to get into a very interesting and unique data source. It's entirely publicly available and actually legally mandated, that applies specifically to US and London traded futures markets. I'm talking about what's known as the Commitment of Traders Report. Now, it's released weekly here in the US by the Commodity Futures Trading Commission, the CFTC, and in the UK, the data comes from ICE, which is the Intercontinental Exchange. In my experience, a lot of individual investors and traders, especially those who mainly focus on equities, stocks, they don't follow the COT reports, and I think that's a huge mistake. It's definitely helped me identify a lot of profitable trends over the years that don't show up as clearly anyway in the market fundamentals or on the charts. So let me explain. The Commitment of Traders report basically tells us two things. First, it tells us about sentiment. Are traders, the speculator crowd, extremely bullish or bearish a particular commodity, whether it's oil, gold, silver, corn, wheat, or copper? Second, it tells us what the so-called smart money is doing. Who is the smart money? Well, in this case, I mean the companies actually involved in the markets we're watching. For example, it stands to reason, it's just logical that a company that actually produces copper, say, or that uses copper as a major input to make a product, well, they might know a little bit more about the supply and demand conditions in that market than you or I. They're insiders, if you will, and we can watch their footprints in the Commitment of Traders dataset. I think the simplest and most effective way to explain how this works and how I use this COT data is to look at a historical example quickly, and then I'll move on to the opportunities I'm seeing in the most recent report released on Friday afternoon, August 7th. Now here's a chart of front month West Texas Intermediate oil futures over the past 18 months or so. So at the end of January 2025, last January, WTI was trading a little over $70 a barrel, and oil generally drifted lower right up until the end of last year, the end of 2025. Now the green shaded region I just added to this screen, that represents a technical support level on the charts. Basically that's just a price region from which oil has tended to bounce, or tended to bounce last year anyway. And that level was roughly between $57 and $60 a barrel. Now looking at this chart though, I'd say there was really no particularly compelling reason to get long oil last autumn or into late 2025, really. WTI was just kind of bouncing along that low level, that support level for most of this time. However, if we look at the COT data, it adds an additional layer of information to my chart. So take a look. Now this chart shows the net position for what are known as non-commercial traders in the WTI crude oil futures and options markets. And I took this all the way back to 2016, the last 10 years. I define that as the gross long position. So the net commitments would be the gross long position, the bulls, less the gross short position, the bears. Each WTI oil futures contract covers 1,000 barrels of oil. And so this chart shows the net position in contract terms. So a reading of plus 200,000, for example, that would actually mean the non-commercials are long a notional amount of 200 million barrels of West Texas Intermediate crude oil. And a barrel is 42 gallons. Non-commercial traders are the large speculators. So think hedge funds, commodity trading advisors, CTAs, and institutional money managers. Because of their size, the CFTC, the regulator, requires them to report their positions every week. Crucially, they have no physical underlying business to hedge. They aren't an oil producer locking in prices to protect cash flow. They're pure financial players taking a directional bet on price. These are the non-commercials. Now this is crucial. Non-commercials are a contrarian signal. Some people call them the dumb money, though that's really just not fair. They're really just trend followers in many cases, and accordingly, you often see them get increasingly bullish into a rising market and increasingly bearish or short into a falling market, right? They're just riding the trends. What's interesting isn't that, it's when their position hits a historical extreme. When they get very bearish, for example, relative to historical norms, and I'll show you how we measure that in a minute, or how I measure that in a minute, that can often be a signal that there's a lot of bearish news on oil in this case that's already priced into the market. The bearish story is already very well known and it's fully embraced by the crowd. It's consensus. It's groupthink, if you will. That's when you should start looking for a potential move in the opposite direction. Now, do you see how the non-commercials position on October 21st, 2025, I've labeled that here. Well, it sank to the most bearish extreme on my chart dating back to 2016. Indeed, if my memory serves, that was the most bearish positioning we've seen in WTI oil futures since 2009 or 2010. So the crowd was very, very bearish oil, just as WTI was scraping along near that $57 to $60 support level I showed you on that prior slide. Of course, non-commercials' net position in WTI can fall for two reasons. Okay, so they could reduce their gross long position. Remember, it's gross longs less gross shorts. So they could reduce their gross long position by selling oil futures and options on those futures, right? Or they could increase their gross short position or buy put options, which it would be an effort to try to profit from the fall in oil prices. So they could get less bullish, reduce their longs, or more bearish by increasing their short positions in aggregate. So here's the gross short side of the non-commercial data. So this chart covers the period from late January 2025 to the present time. Now the red line is just the weekly close for front month WTI futures, okay? Because remember, this COT data is a weekly data set, and so I matched up those dates. Now that blue line, based on the right-hand scale on the chart, and when you're looking at it, shows the gross non-commercial short position on the corresponding date. Okay, so instead of expressing the gross short position in terms of total short contracts, we're looking at what's known as a Z-score. To calculate this Z-score, we're looking at the past 104 weeks. Now that's 2 years, obviously, of trailing data. Specifically, we're comparing the current reading of that gross short position to the average reading over those past 2 years, 104 weeks. So, for example, a reading of plus 1.5 on this chart would indicate a gross speculative short position, basically a bearish view on oil, that's 1.5 standard deviations above the 2-year mean average. As a rule of thumb, any reading here of plus 1.5 to 2 standard deviations or higher, or on the other side, negative 1.5 to negative 2 or lower, right? That would indicate a very lopsided view. So in this case, we're looking at a positive reading, plus 1.5 to plus 2, would indicate a lopsided bearish view on oil. This is a much larger than average gross short position. And I'd consider that potentially contrarian bullish. Now look at how that worked out last year in oil. We saw a 2.95, a plus 2.95 standard deviation max short speculative position on October 21st of 2025. It did not mark the exact bottom in oil. It rarely does, as I'll talk about in a minute. But clearly, the bearish speculation on oil was running rampant, and sure enough, crude oil prices failed to fall much further after late October of last year. They actually carved out a nice low I've drawn here between late October and late December, over basically a 2-month period. And of course, oil saw a big rally into early 2026 this year, with WTI hitting highs around, sort of $113 a barrel in late March and early April. Do you see how that bearish, non-commercial position in WTI oil futures and options signaled a bearish extreme late last year and pointed to the potential for the rally we saw. Now here's the commercial side. Okay, this is the smart money side. Now, I don't want to belabor the point, but what you're looking at here is the net commercial position in crude oil futures and options since August 2024. So that's the past 2 years, which I've also expressed as a Z-score. Remember, these are the hedgers. They're industry insiders like oil producers. So I like to watch how they react to trends in price in this case. So in this case, in late October, the commercial position reached a Z-score of over plus 2.5 standard deviations as oil prices were scraping along, again, that support level between $57 and $60 a barrel. Now, this does not mean that the smart money wasn't short oil. Actually, they're almost always short oil or buying put options to a certain extent, not because they're bearish necessarily, but because they use these markets to hedge their exposure to commodity prices and lock in some level of cash flow, at least lock in some level of cash flow on a portion of their production. Now you have to remember the context last fall, right? There were plenty of pundits out there talking about a mega glut of oil, or super glut I think it was called, and the potential for prices to fall well below $50 a barrel. Some were even calling for oil in the 30s a barrel. So it makes some sense producers would want to lock in hedges covering some of their production at around 60, or high 50s, low 60s, because that's a level at which they can at least generate some level of free cash flow. What this commercial Z-score of plus 2.5 standard deviations does tell us is that energy producers weren't hedging much, or more accurately, they weren't hedging as much as normal, with normal defined as the average level of hedging over the past 104 weeks, 2 years. Oil producers were not keen to lock in oil prices that low, in that $57 to $60 barrel area, or really if you went out into early 2026 back then, you were only getting prices in the low to mid 50s, right? Then look at how the commercial position plummeted to a Z-score of -2 standard deviations in late March of this year as oil prices were spiking over $100 a barrel. So that was about a month, a little less than a month, a little over a month into the Iranian conflict. And traffic disruptions through the Strait of Hormuz that happened shortly thereafter. So let me put these two charts up side by side so you can get a better look. Okay, that's WTI on the left and the commercial Z-score on the right. That -2 standard deviation Z-score in March told us that the smart money in oil was aggressively hedging their exposure to crude into that big spike to over $110 a barrel. It's the inverse of the situation we saw late last year. The smart money wasn't hedging much when oil prices were low and then started hedging more aggressively as prices spiked this past spring. Also, please understand this is relevant even if you do not trade oil futures. Even if you prefer to focus on equities, stocks, energy stocks in this case. So here's a chart of the SPDR Energy ETF, which trades under the symbol XLE. Now it's a market capitalization weighted basket of energy stocks in the S&P 500. So it's weighted by firm size. So that means that it's really heavily weighted to Exxon and Chevron. I think they're a little over 40%, 45% of this ETF. So as you can see, combined. So as you can see, over a period of about 5 months here, from late October of 2025 through late March of this year, well, XLE returned over 46.5%. Now that's a huge move, especially for an ETF that's so heavily weighted to two stocks, Exxon and Chevron, which tend to be on the slow moving side. They're big cap energy stocks. They move a lot less, a lot more slowly. They're less volatile than a lot of energy stocks out there. Now, certainly a lot of energy stocks perform far better than that 46.5% over that period. So with that framework in mind, let's take a look at the current situation. Now this is the latest data released by Commodity Futures Trading Commission, CFTC, on the afternoon of Friday, August 7th, last Friday. And let's take a look at a few markets where I see potential opportunities being signaled by this data set right now. Now, as I said, this data is all publicly available through CFTC's website and through ICE Europe Energy Futures for markets like Brent crude oil. That's exactly where I get this data every week, straight from the source. Now, it is in raw form. These are raw CSV files. Basically, you can manipulate them in Excel. But if you want to track these positioning numbers yourself, I have put together a clean Excel spreadsheet covering the last 2 weeks of commitment of traders data across actually about 20 major futures markets. Now, I'll throw up a portion of that table here on your screen. You can also grab the full file for free via the download link on my Substack here. Now that's open to all free and paid readers to the Substack. If you happen to be watching this on YouTube, I'll go ahead and pin the link in the top comment down below. So all you need to do to be a free subscriber is to follow that link to my Substack, the Free Market Speculator, and just input your email. You can cancel anytime as well. If you would like this data download to be updated more frequently, so you can track this on an ongoing basis, just let me know in the comments. I'll leave them open to all readers. I tend to look at the commitment of traders data almost every weekend. Okay, so up first, let's look at the non-commercial side. That's the speculator side with this first table. As I said, the commitment of traders is a weekly report released by CFTC on Friday afternoons, and the data is calculated or updated as of the market close on the prior Tuesday. So there is a delay here. The data we're looking at here was released on Friday, August 7th, and represents futures market positioning as of the close on Tuesday, August 4th. Now, I tried to keep it simple here by tracking, as I said, 20 or so markets. I actually do track a lot more than that on my spreadsheet, but this is a simplified version. And so what we're looking at is only the 104-week Z-scores for the net non-commercial position and the gross short position. So that's basically what I just showed you referencing WTI crude oil earlier on in this video. Now, 3 markets really jump out here for me. First up is currencies. This is one I've been tracking for a while. Look at those big speculative bearish positions in currencies. A negative 1.64 standard deviation Z-score for the net position in the euro as of August 4th. And that was almost 2 standard deviations bearish the week prior, which was Tuesday, July 28th. Also, that gross short position is more than 2 standard deviations above the 2-year mean. So those gross short positions are the color-coded column on the right-hand side of this table. Look, Canadian dollar, 1.33 standard deviations bearish, and a 1.28 standard deviation above average gross short position. Cable, that's the British pound US dollar cross, that's 1 standard deviation bearish. I also see a lot of pain in the Japanese yen on this table, awful lot of pain. Do you see how the speculators had a negative 2.11 standard deviation net bearish position on July 28th? So 2 weeks ago, the Tuesday before last, and then they covered that down to a negative 0.54 standard deviation bearish position as of August 4th last week. So a lot of covering going on there, short covering. Well, the Bank of Japan and the US government intervened in the currency markets on Friday, July 31st. They confirmed that they did that on Monday, August 3rd, right? To strengthen the yen against the dollar. So those shorts probably got smoked on that move. In fact, during currency interventions like that, your central banks and governments are really kind of counting on covering of speculative short positions to power a significant portion of the move. At any rate, these bearish positions, particularly in the euro, represent bullish sentiment on the US dollar. Because all these currency futures that are traded in the US, they're set up as the exchange rate between the reference currency, whether it's the euro, the pound, or the yen, and the US dollar. So all are set up such that a short position in the futures benefits from the reference currency losing value against the dollar, right? So look at a chart of the euro US dollar front month futures. Since 2022, the euro has been generally strengthening against the US dollar. It hasn't been an entirely smooth ride, of course, rarely is, as the euro sort of initially strengthened from under $1 in late 2022, that was the late 2022 lows, into kind of the summer of 2023. Then it traded sideways for over a year before appearing to actually break down again in early 2025. Now, interestingly, back in early 2025, the speculators were all bearish the euro as it broke lower, much as they were this summer, right? We saw weeks back then in early 2025 and late 2024 too of a z-score on the non-commercials more than 2 standard deviations bearish, or very close to it in some cases. That was a good signal, right? As the euro reversed higher again from a low of 1.02, $1.02 in mid-January 2025, rallying back to a peak just near 120, a little under 120 back in late January of this year. So over a period of a year, that's a big move in a currency like the euro. In July, the euro started to break down again below that key support level I've labeled here on the chart. The speculators became stretched bearish, and guess what? Just like early 2025, we've seen the euro reverse higher, again, back above that technical level on my chart. Now, it's what market technicians would call a failed breakdown from a topping pattern. It's really part of a broader trend in a lot of different currencies. I'm just showing you the euro, but even some of the emerging markets currencies like the Brazilian real lost value against the dollar this spring. However, they've started to strengthen again in a big way in recent weeks. So bottom line is that I think that this extreme bullish speculative sentiment on the dollar, right, actually supports a weaker dollar trend into this autumn. We're already starting to see it as the dollar started to break down again over the past few weeks, right as the non-commercials got so bullish, just as I just showed you with the euro. And this has implications far beyond the US dollar index or the euro or even just futures markets. Now, generally speaking, a weaker dollar could be expected to support precious metals like gold and silver. And we're definitely seeing that already, right? Just recently. Here's a chart of front month gold futures, which saw a nice rally from late 2024, a more than nice rally, a big rally from late 2024, around $2,600 a troy ounce, roughly doubling to those highs we saw early this year. Gold prices have corrected sharply from those early 2026 highs, and they entered that sort of intermediate term downtrend that I've plotted on this chart with the red line. However, since the second half of June, gold has basically consolidated right at an important technical support level around $4,000 an ounce, and then broke higher again just recently out of that consolidation zone back into an uptrend, I would say. It's also positive for foreign stocks. A weak dollar is positive for foreign stocks. For example, in the free market speculator, we've recommended some European and British banks as well as Japanese stocks. We started doing that really aggressively back in that January 2025 timeframe I just showed you, between January 2025 and May of 2025. And we've also added exposure to some emerging market stocks, including a Mexican retailer we added fairly recently. I'd also highlight that I see opportunity in emerging markets local currency bonds. So these are bonds issued by emerging markets governments like Brazil, or even some of the Middle Eastern countries like Saudi Arabia, right? These are issued in their local currency rather than US dollars. So we've had a position in ETFs tracking this market in our Smart Bond service, and I just added to those allocations in the model portfolio last week. So actually, here's a chart of one of those ETFs. Now it's the Van Eck JP Morgan Local Currency Bond ETF. The symbol is EMLC. And this chart does account for both the price appreciation, but also the distributions paid by this ETF, exchange traded fund. Now, EMLC pays monthly distributions, which add up to about a 6.2% annualized yield. At any rate, those are just some of the markets I look at when I'm expecting a weaker dollar trade, or at a minimum, a range-bound dollar trade. After all the breakdown on currencies we've seen, like the euro and the Canadian dollar against the US dollar, really failed badly right as those non-commercials got so very bearish. That's the sort of setup I like to look for. So let's go back to my big table here. On the energy side, look at NYMEX traded US natural gas futures. With a speculative non-commercial z-score of negative 1.68 standard deviations and an enormous gross short position of 2.54 standard deviations above the 104-week average. Now, I've put a black box around the gas market row on your screen so you can hopefully see what I'm on about. That's a crowded short. Now let's flip over and look at the commercial side, which is I'm going to throw up on your screen right now. And this is also part of the file you can download just below, as I mentioned. The net commercial position in natural gas is positive 1.7 standard deviations. So what that means is the smart money is positioned in a much more bullish fashion than the average of the past 2 years. In all likelihood, I think that probably represents a combination of two things. First, natural gas focused producers here in the US, well, they aren't hedging as much as usual because they don't want to lock in current low gas prices. They think there's a good chance probably the gas prices will be higher than they are right now in the future, and so they don't want to lock in current ultra low pricing. Second, major buyers of natural gas, like maybe power generators or chemical producers that use gas as a feedstock, well, they're probably buying gas futures or call options to secure longer term supply at attractive low gas prices right now. The current situation in gas actually kind of rhymes with what we saw in oil late last year. As I showed you earlier, the speculators were bearish oil, very bearish oil in late October 2025. And to be fair, there were a lot of negative headlines out about oil late last year. OPEC was boosting production into a market that already looked potentially oversupplied. There was a huge buildup of oil and floating storage, mainly Iranian and Russian barrels being stored on tankers. The International Energy Agency was forecasting a huge oversupply of oil into early this year, millions of barrels per day of excess supply, record-setting in some cases. However, that huge bearish speculative position told us that a lot of that news, that bad news, well, it was already priced in. It was already in the price of oil. Meanwhile, the smart money, the commercials, were leaning the other way. They were bullish oil. Well, today, there are plenty of legitimate reasons to be bearish U.S. natural gas prices. Let's take a look at some of them. This chart shows weekly data on U.S. natural gas storage as a blue line. The orange line is a 5-year seasonal average, and the green bars show whether storage is above or below the 5-year seasonal average. Obviously, a positive number there, a glut of oil versus a 5-year average, is usually bearish for gas. And as of the most recent week, U.S. gas storage is some 195 billion cubic feet higher than what would be considered normal this time of year. So the supply-demand balance is undeniably a little on the loose side. And then there's the El Nino, what some are calling the super El Nino. Well, that just sounds pretty dramatic, doesn't it? But bear with me. Here's a map of the world with the land masses in gray and the ocean sea surface temperatures color-coded, such that dark red colors indicate above average temperatures in particular. Now, do you see this region of the tropical Pacific Ocean here off the west coast of South America? I circled it for you here. Well, this region has higher than average sea surface temperatures, and that's called El Nino. And believe it or not, it has widespread weather impacts across North America. Basically, the southern United States, like down here in Florida, well, we tend to have cooler and wetter weather than average in El Nino years. Fewer hurricanes, though, than normal during hurricane season, like now, and that's kind of nice. However, the northern tier of the US and Canada tend to have warmer and drier weather than average, particularly in the winter months. As much as it might annoy me to have cold weather down here in Florida next winter, the fact that winter heating demand is still the key seasonal driver of gas demand in the US, and a typical warmer than average winter across the upper Midwest and Northeast is bad news for gas demand this winter. No denying that. Here's the latest projection from NOAA, the National Weather Service, for the months of December 2026 and also January and February of next year, of 2027. The height of winter heating season coming up and the peak of US gas demand. Do you see how the entire upper half of the country and Canada, right, have elevated probability of above average temperatures? Again, bad news for gas demand this coming winter. So plenty of reasons to be bearish gas prices, just as there were plenty of reasons to be bearish oil last autumn. And look at this. This is what we call the natural gas futures curve. It shows the price of natural gas for delivery in every month from September 2026, that's actually the current front month, through December 2028. Granted, the curve has a normal seasonal shape here, January 2027 futures, that's the height of winter heating season. They're trading north of $4 a million BTUs because that's a time of peak gas heating demand. But look out there at the spring of 2027, spring of next year. This is what we call shoulder season, weaker gas demand. And you can clearly see gas prices are below $3 a million BTUs, very low historical levels. Indeed, the futures curve isn't pricing in any healthier gas prices until late next year, late 2027, or really into 2028. However, the important point to remember here is it's not the fundamentals that actually matter, but how the market reacts to those fundamentals. Put it in a different way, a known fundamental is a useless fundamental. If everyone already knows that next winter will probably be warm, you probably can't make money on that likelihood because it's already priced into the gas market. That's how markets work. That certainly appears to be the case. This chart shows the non-commercial Z-score in natural gas since 2017, and as you can see, the speculators have been consistently bearish gas for weeks, with that Z-score spiking down well below -2 recently. At the same time, there are plenty of potential upside catalysts as well that are all too often ignored, I think. A 4 billion cubic foot a day increase in US liquefied natural gas export capacity into early 2028 as new export terminals ramp up. Natural gas prices in Europe and Asia are 4 to 5 times higher than they are here in the US. So producers will be eager to export more when those terminals ramp up so they can take advantage of that price differential. Rising US electricity demand, supported in part by electricity-hungry AI data centers, artificial intelligence technology, and gas generation facilities being specifically set up to serve those AI data centers. And industrial demand, including the use of gas to make nitrogen fertilizer. Well, that's also growing at a faster rate than we've seen in many, many years. Even El Nino isn't a guarantee of a warm winter. It's a tendency, probability, not a guarantee. So if the winter of 2026-2027 is actually just normal, average, or even a little cold, not that unusual in an El Nino year, that would also likely catalyze a significant rally in a market that's just not positioned in that way. The speculators are off sides for any kind of upside in gas. Now let me warn you, they don't call the US natural gas futures market the widowmaker for nothing. US gas futures are very volatile, especially around key weather windows like winter heating season. Also, please understand that the Commitment of Traders report isn't always a great timing indicator for trades. Just remember, the speculators got maximum bearish crude oil in late October of 2025, and while WTI didn't really fall much more after that, it didn't start to take off until right at the end of last year and really into early this year. So those big turns can take some time, months to play out. So I tend to favor holding some exposure to high quality US natural gas producers, particularly those with acreage in the Marcellus Shale, which is in Appalachia. That's the cheapest to produce US natural gas shale field, or the Haynesville Shale in Louisiana. The Haynesville is a little more expensive to produce, but it's closer to the Gulf Coast, the US Gulf Coast, which is where all these new LNG terminals are being built or are already in existence. So the final market I want to cover is the long bond, the 30-year US Treasury bond. Now I won't take too much time on this one because I just published a post about it over on the Smart Bond Substack just last week. I'll link to that also down below. Suffice it to say that in the bond market, I track the COT data a little differently than I do for a commodity like oil or gas, or a currency like the euro or the pound. That's because the non-commercials category, the speculator crowd, it's a little contaminated by groups of traders who aren't really speculators, that are defined as non-commercials, but they aren't really speculators. For example, consider a pension fund or an insurance company who buys or sells bond futures to match the duration of their portfolios to their obligations. That's more of a hedging than a speculative function, but they're considered non-commercials in this data set. So what I look at instead is the disaggregated COT data. Okay, so Commitment of Traders data known as disaggregated. And in particular, the positions held by leveraged funds. So this category, think hedge funds, institutional traders who are actually taking a view on the path of long-term Treasury bond rates and prices, yields and prices. So what we're seeing there is a very crowded speculative short position in the 30-year Treasury bond and what's known as the ultra 30-year Treasury bond futures. To be clear, these are speculators taking the view that 30-year Treasury prices will fall and therefore yields will rise further. So, and 30-year Treasury yields are already elevated, reaching the highest level since 2007 recently, up north of 5.2%. Look at this chart, which is known as the DV01 for the 30-year and the 30-year Ultra Treasury futures combined. What it shows is that leverage fund speculators have such a huge short position in the long end of the curve that they make over $283 million collectively for every 1 basis point rise in 30-year Treasury yields. And a basis point is 1/100th of 1%, 0.01%. Now, we've all heard the fundamental reasons for thinking long-term treasuries will go lower and yields will spike, right? Sticky U.S. inflation, a deteriorating U.S. fiscal position, to say the least, and the need to issue more bonds, right? Raise more capital, raise more debt to fund government spending and just pay interest on that huge U.S. national debt. However, everyone already knows this, which is why we're just coming off the largest speculative short position in 30-year treasuries in history. It's going to be tough, in my view, for 30-year yields to rise much more with sentiment already that stretched bearish, projecting or betting on higher yields. Again, for more about what's happening and what you can do about it in the bond market, check out the Smart Bonds articles I released last week. Again, I'll link them below. So thanks for listening. I hope you enjoyed this week's Sunday Deep Dive. If you did enjoy this week's video, please drop me a like or a comment. And you can subscribe for free to make sure you receive this weekly video and my other posts and updates as soon as they're released. Now, as a free or paid reader, as I mentioned, you can also download the latest Commitment of Traders data, the tables I presented in this video, using the link down below. And if you're a paid tier reader, you'll also see the model portfolios below, updated through the close on Friday, August 7th. If you'd like to give the paid tier Free Market Speculator a try, including our popular Energy Bulletin Top 10 model portfolio, I'm still offering for a limited time 14-day free trials via the link below. Thanks again. I'll see you next week for another episode of my Sunday Deep Dive.